Hi, Paul Gerard from Price Accounting Services. Look, I want to talk in this amended video, new video for our property taxation series. This is about depreciation, okay. In the 2017 year, in the budget in May 2017, there were changes announced to depreciation rules, okay. The concept behind it is the government announced a gradual elimination of depreciation deductions for investment properties that are residential, not commercial. What does this mean? Okay, the initial rule says that if you contracted to buy a property after the 9th of May 2017, then you can't get depreciation deductions unless you meet some pretty stringent new rules. So the idea is most people will fail that rule and won't be entitled to it. So what do we mean by depreciation? Okay, when we look at a quantity surveyor report, there are two elements. There's Division 40, which covers your plant and equipment items, your air conditioning, your oven, stoves, bits and pieces like that, okay? Then you have your building construction component, which is Division 43. Those two elements combine in the schedule to give you deductions, okay? So typically speaking, these new rules impact by stopping people who buy an existing property, okay? So for example, I buy a property from Fred down the road a month ago, I settle on it today. The property might only be 2 years old, but I can now not call in a quantity surveyor and claim that Division 40 that was incurred by the prior owner when they bought it. So that's going to erode some deduction benefits for some investors. It's not major. The older the property, the less likely the issues material, okay? You know what I've been saying to everybody who's been asking this over the last year? Speak to a quantity surveyor. I still don't believe there's many instances where it's not worthwhile getting a quantity surveyor report, okay? So if you've bought a property and you're asking the question, well, should I bother? The answer is yes, you bother, okay? Until BMT, Washington Brown or Depreciator have told you to not bother with a quantity surveyor report, then I think you should bother, okay? I typically find clients who claim thousands of dollars a year in deductions from Division 43, the building construction element of the depreciation report. So, you know, some taxpayers are going to lose a couple of $1,000s in deductions that they may have been entitled to, okay? But there's also a new benefit, okay? So when you call up a quantity surveyor and get a quantity surveyor report now, they can still identify those items that should have been depreciated but can't. And what they'll issue is, and they all use different names, but they'll issue you with a report now that still lists the value of those items and the amount that could have been claimed if it had been deductible. Why would we want that? Well, thing is, let's say you sell that property in 5 years' time, the amount you could have claimed will be a CGT loss, okay? So you might miss a deduction, but you'll pick up a CGT loss. So I think there's still some real merits in still getting quantity surveyor reports, and only if quantity surveyor tells you not to bother, should you not bother, okay? So that's the key message. So if you've got any questions about your quantity surveyor report, we welcome it, okay? For all of our clients, there's a couple of people who are more severely affected than others. Now, who are they? When they announced the budget change in May 2017, anyone who owned a property, even for one day in the 2017 tax year, could be affected. When they passed the final legislation, contained I'd describe it as a nasty little rule. The rule says that if you owned the property during the 2017 year and you didn't produce income, then the former assets also can't be depreciated. So wow, who does that affect? Okay, so let's say you settled on a property between the 9th of May and the 30th of June 2017. If your 2017 tax return does not show that property earning income, then you may not be eligible also, just as other owners who settled after that date. I think it's a bit of an unfair rule, but that's how the law has been written, and that's how the ATO will reflect their decisions. So if you believe that's you, we do need to know about that. The other group of people that are going to be affected by these changes, anybody who has a change to their property. Okay, and this is going to be broad, because what the government's rule was, it's to try and erode so less people will become entitled. So in 20 years' time, we may see people who just don't claim Division 43 anymore unless it's a brand new property. Okay, that's the new regime. So who's going to be affected? Okay, so anybody who ceases to use their investment property as an investment property will be caught by this. So, examples: a holiday house where you might come and go, an investment property that you move into, and then you move out again. You won't be able to recommence the depreciation, despite your Quantity Surveyor report saying you've got all these Division 43 deductions for years to go. You cannot claim them, okay? What I suggest there is take that report, call the Quantity Surveyor and get them to amend it. Ask them to update it to reflect the new rules. And they can easily issue with that CGT saving amount for future years, okay? So you're going to exchange one loss for another benefit, okay? So any property use we need to know about. So as accountants, and if you're a DIY taxpayer, you need to be on top of this stuff. And if you don't, you're going to face years of penalties. If in 3 years' time the ATO find that you are claiming deductions for a property that isn't eligible, you could face not only a back payment of the taxes for those 3 or 4 years or whatever it might be, but also the penalty that goes on top plus the interest. So it's not uncommon to find it can double the cost. So if you're not sure, seek tax advice, and our new 2018 tax checklist certainly caters for all these issues. We do ask these questions about property use. And the other thing too is our MyCGT record keeping tool, which we provide all of our clients, is a fantastic place to keep records of those changed use of each property, so that when you do get to a CGT event in 5 years or 50 years or 20 years, whenever it is, we've got the information, or you've got the information, so you can make a correct, valid calculation and minimise whatever tax you're going to pay, okay? So hope that's been helpful, and hope it hasn't all been doom and gloom and bad news, and look forward to any inquiries or seeing you in another one of our videos soon. Cheers.